What's up everybody, welcome to the channel. Soil here, and today we're going to talk about unbalanced volume. It was developed by Joe Granville and introduced in 1963 in his book Granville's New Key to Stock Market Profits. By the help of unbalanced volume, we can determine when smart money is active and flowing in the market. If you're interested to learn this excellent indicator, stay tuned and let's get started. Alright, here we go. We have unbalanced volume here below the chart, as you can see, and let's see how we use this indicator. The main usage of unbalanced volume is to discover when smart money, which is from institutional traders and investors, and not so smart money, which is from retail traders and investors, are active and flowing in the market. Technical traders believe that price follows volume, so if the volume increases without seeing rise in the price, then advancing in the price is expected to happen. As you know, the money that actually moves the market is from large-scale trading, which is from institutions, and it's called smart money. So if you can determine when this smart money is flowing in the market and in what situation or direction, so you can identify changes in the direction of the market in the earliest stages of developing. Smart money is more likely to flow in the market when the market is calm, actually when it's low in terms of price action. But retail traders become active and more active in high buying or selling pressure days. Let me give you an example. Consider the market is in a downtrend. A large amount of buy orders must be placed in order to change the direction of this downtrend into an uptrend. Lots of buy orders are needed to just cancel the sell orders and cause the downtrend to pause, and the price may go to a consolidation before heading up. But you must pay attention that the volume is building. At these situations, when the trend is stopping or the market is flat, actually the volume is low, institutional traders are more likely to step in and buy. As you know, the price reverse and rise when enough buy orders are placed that are greater than sell orders in terms of how much money is on each side. At this point, retail traders step in and start to buy because they see rising of the prices and they think a reversal happened and an uptrend is forming. And as the price goes higher, more and more money from retail traders flow in the market for buying, and institutional traders may start to sell to lock their profits. So as you can see in this example, if you track the money that is coming from institutional traders flowing in the market, it can be a great help to you to spot changes in the direction of the price in the early stages. Unbalanced volume is a cumulative indicator, which means it's simply a running total of positive and negative volumes. Based on your time frame, volume in a period is positive when the close is above the previous close, and it's negative when the close is below the previous close. So current OBV equals previous OBV plus current volume when the volume is positive, and current OBV equals previous OBV minus current volume when the volume is negative, and current OBV equals previous OBV when the close is equal to previous close. Actually, when the price increases, the volume is added to the running total that is making the OBV figure, and when the price decreases, the volume is subtracted from the running total. In OBV calculation, the volume is additive when the price is increasing and it's subtractive when the price is decreasing. So generally, OBV follows the trend of the market and it increases in uptrends and decreases in downtrends. We don't look at the real number value of the OBV for analysis because it depends on the starting point of the calculation. Instead, we analyze the movement of OBV over time. Actually, the slope of the OBV is the most important part for analysis. So in practice, we find a trend for OBV and we must see if the OBV trend matches the price trend. If OBV is rising but the price is moving down like here as you can see, or if it's flat, so you can expect that the price is going to advance. Or if OBV is falling and the price is moving up, or it's flat, so you can expect that the price is going to decline. This is called divergence, and we can use divergences between unbalanced volume and price to forecast a possible reversal in the price movement. Actually, this divergence shows that the smart money is flowing in the market and the buying volume is building. Let's see what kinds of divergences we have. Bullish divergence forms when the price makes lower low but unbalanced volume makes higher low, and this divergence shows that a reversal in the direction of the price is possible to happen. As you can see on this chart, following this downtrend, you see that the price is making lower low but unbalanced volume is making higher low. and this shows that buying volume is building, and you see after that the price changed its direction and turned to an uptrend. Also, when the price is in a trading range moving flat but OBV moves higher, this can be indication of possible breaking of the range and advancing of the price. As you can see on this chart, here and here the price is in a trading range moving flat, but unbalanced volume is moving higher in these periods, and you see that the ranges are broken and the price advanced after that. And bearish divergence forms when the price makes higher high but unbalanced volume makes lower high, and this shows that a reversal may happen in the price movement. As you can see here on this chart, the price is making higher high but OBV is making lower high, which shows that the selling volume is building, and as you see the price started declining and changed its direction. And also when the price is in a trading range moving flat and the OBV moves lower, this shows that the range is possibly going to be broken and declining of the price is probable to happen, like this case that the price is in a trading range here but the OBV is moving lower, as you can see, and here the range is broken and the price declined after that. Please pay attention that a divergence only gives you the possibility that a reversal may happen, and you may have a divergence but after that the price continues its direction, like these two consecutive bullish divergences that we have here, but the price continues declining because the downtrend is strong and the downside momentum still outweighs upside momentum. So please pay attention that you must never trade only based on these divergences, and like any other indicator, you must use unbalanced volume in conjunction with other tools and aspects of technical analysis. Alright, that's it. Thank you for watching this video and I hope it has been helpful for you. If you have any question, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you found any value in this video, please like it. Please subscribe to my channel if you haven't already and hit the bell so you get the notifications of my new videos. See you guys in next video and good luck with your trading.